Almost 5 years ago to the day, the COVID-19 pandemic hit home in a way few Americans could have imagined. Schools closed, travel ground to a halt, lockdowns were implemented from one end of the U.S. to the other. Millions were sickened, and hundreds of thousands died. In addition to being an enormous human tragedy, the pandemic had wide-ranging impacts on the economy, markets, policymakers, and investors. And the lessons learned during those turbulent times and their aftermath have been a key area of focus for my next guest. Is David Kotok, co-founder and chief investment officer of Cumberland Advisors and author of the just-released book, The Fed and the Flu. David, welcome to the Money Show MoneyMasters Podcast. So David, again, thank you so much for taking some time out to talk. Let's chat about your book, The Fed and the Flu. What are you attempting to cover in this book? Talk a little bit about what a reader is going to find out in this tome.
Mike, thank you. What we did is this. We looked at epidemics, pandemics, and plagues in economic, financial terms. And what we found is throughout history, epidemics, plagues have economic effects, asset prices, inflation, wages, reactions from central banks and governments that are unique. They are different from hurricanes and tsunamis and wars. They're a special kind of shock. And we started this because of a Federal Reserve study right at the beginning of COVID. And that was the trigger. I read that study. It was done by the San Francisco Fed. And I said, they're onto something. COVID is different. This is not a war. And I started to look at their work, and then we expanded it. And by the time we're done, we have a book that looks at 3,800 years of history, antiquity, after the Dark Ages, and the 4 periods when the Federal Reserve has been in existence, what the Fed has learned. And I believe it will help people understand the Federal Reserve's evolution and policy with COVID.
David, why is this topic so important now? I mean, we're essentially exactly a half decade from when I think that the world realized just how serious this was going to be, and things began to shut down and so on in the U.S. What's the importance of this topic?
So why is it important? 2 reasons. What we found is that when you have a pandemic, a plague, an epidemic shock, there's a long shadow that follows. So it's not a short-term shock. The intermediate shadow of a plague can run 10 and 20 and 30 years. We are seeing that in the United States and around the world today from COVID, which started in 2020. That shadow is in existence today. That's the first element. The second element is, well, you look around right now, and what do you see? You see a measles outbreak raging in Texas. Will you see reactions from children who haven't been vaccinated? Why the disruption? Plagues, epidemics trigger disruption. The second thing is we have bird flu everywhere in cattle and birds and cats and mammals. What we haven't had yet, hopefully we won't, is a cluster of human-to-human transmission. So the book has 2 lessons. 1, long shadow. 2, history repeats and repeats and repeats. And unfortunately, the human being is a poor student. And so that's the second lesson.
Let's talk about what your research showed about past pandemics, Spanish flu, and going even way back, as you said, to antiquity and COVID. What were some of the similarities and differences you saw? Again, kind of looking at the economic side of things.
Well, there's a unique side to an epidemic. You lose people, but you don't lose capital. So when you lose people and you don't lose capital, what happens? The poor people, the heirs from the poor people, don't inherit very much. The heirs of the rich people inherit and get richer. Wealth per capita goes up. Secondly, In a pandemic shock, you have a change in productivity. Now, in the old days, it used to be the least productive farm was left to lie fallow. In the new days, there's more innovation, although we had innovation in every pandemic. We had it in antiquity, in tools of war, in weapons. We have innovation today accelerating in AI. Every pandemic shock triggered innovation, and in that, productivity went up. So think about this characterization. Productivity per capita goes up, wealth per capita goes up,
Hmm.
you get a different economic climate. And that climate, if there is no war, and if the governance doesn't disrupt it, which is a question now, you get asset prices rising, you get inflation then rolls over and levels out low. You got a productivity gain so that you have wages that can be sustained because of higher productivity at higher levels, and a glorious middle period. And I believe the stock market is teasing us with that right now, and it's not well understood. And interest rates behave. The neutral interest rate goes down after a pandemic. The neutral interest rate goes down. And what we found in history is central banks and governments don't realize that because they're trapped in the paradigm of business cycle shocks. So the lower neutral interest rate allows this long period. And I believe we're in that one right now. We are seeing it. And we're seeing the long shadow of COVID in long COVID. Disability, adjustments for disability, quality of life. Somebody loses their hearing in 1 year from COVID. Somebody else has we have between 9 and 17 million people in the United States with persistent long COVID symptoms. You and I know some of them. And so that's part of the long shadow. And I believe we have that in front of us for 5, 10 more years, 15 more years, something like that.
So let's talk about the implications of that for investors and policymakers here. I mean, how can they adapt to this thesis if this is what your research is showing?
Adaptation requires acceptance and belief. It's very hard to get traditional monetary economists to say, wait a minute, maybe the neutral interest rate is really lower, because the traditional models would tell you the opposite. And the second thing is, you look at asset prices, we hear it all the time, value metrics against the stock market, the Magnificent Seven, the PE is too high. Well, is it too high? Is it too high if we're going to have a lower neutral interest rate, more productivity growth? And the factor is the innovation factor. Maybe it's not too high. Maybe it's too low. Who knows? We don't know. What we do know from history, and we have identified in the book, antiquity, more recent times after the Dark Ages, and the history period of the last 100 or so years. And what we do know is history has repeated itself each time. Look at the Spanish flu, if I have a minute, and say you had the Spanish flu. John Barry said 1918. It was really a period from 1917 to 1922. There was a resurgence in the United States in 1921. It was spread with the help of a war, but it didn't trigger the war. And look what followed. What followed in the roaring 20s was a boom without inflation. A magnificent period for investors, for society, for productivity gains. Everybody looks at that and says, oh, why did that happen? Well, we invented the automobile. We had the flappers dancing and made us all happy. You can make up 100 reasons. History says that's the same thing that happened after the Peloponnesian War and the plague in Athens. That's the same thing that happened in other periods of history, in that period after the initial pandemic shock. So we looked at it, we've documented it in the book. We started with a list of the 19 epidemics in the San Francisco Fed study. We expanded it to a master list of 314 epidemics in the history of the human being on the planet. And then we condensed it into these periods and documented what we found.
Excellent. David, I want to broaden out the discussion a little bit talk about markets in the time we have left. I mean, what else are you seeing out there in terms of your outlook beyond sort of the long tail impacts of COVID that are driving this market?
The market is in a struggle, in my opinion. It's listening to rhetoric from Trump 2.0. It listens to, or hears, I don't know what it listens to. It hears tariffs, 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 bluster, bullying, rhetoric. We've actually only had one small tariff change on China so far as we're speaking today. Who knows what'll be announced tonight and tomorrow? We are seeing a reconfiguration in government, which is something we have not seen rolled out rapidly. And execution has been designed and is happening. Now, whether you agree with Trump or disagree with Trump, or you don't like his style, is one thing. But I admire the execution. They are rolling out a plan. Is it Project 2025 or something like that? Maybe. But they're doing it. Whether we get a good result or a bad result is the subject of debate, but we're getting a result that is disruptive. And the disruptive type of new executive branch we haven't seen since Franklin Roosevelt in 1933. That's what's happening now. How markets deal with this is a puzzle because you have so much uncertainty, which means you have no probabilities. You can't predict anything. You wake up tomorrow and you have 3 more executive orders and you're not sure what they mean. That's where we are.
Understood. Volatility certainly seems to be with us, even just the first couple of months of this year. You can see it. David, let me ask you about policymakers. Obviously, you have a lot of great contacts and sort of following what's going on in the policymaking world. How do you think the Fed and some of the global central banks react to this environment that we have here as the year goes on?
So far, central bankers are very careful here because they are products of their governments, even if they are independent. Remember, it's a creature of Congress that created the Federal Reserve and amended the Federal Reserve Act. And so you hear the Federal Reserve and other central banks in the world trying to be very neutral. That's the right thing for them to do. They're in the monetary policy, inflation, maintain growth, financial stability, don't let banks collapse business. That's what a central bank does. And they're trying to wear a helmet and avoid being a political target. I hope they are successful because the Federal Reserve in COVID, in my book, I praise what they did. And in terms of financial stability, Mike, look at what we just had with Silicon Valley Bank. We had sequential 200 billion bank failures, and there was no meltdown. No, everybody ignores that now because a tragedy didn't happen. Well,
Absolutely.
that's like plumbing. You take it for granted when it works.
Absolutely. David, I guess I want to sum things up, just ask you your general market take. I know we've had you speak in our Sarasota events the last couple of years. You generally seem fairly positive on the big picture. Is that still the case? And how do you think things are going to sort out this year?
Well, if we don't have a war, then that's an if. And we look at a lower neutral interest rate, which I believe is the situation. When I was on stage with you At the Money Show a year and a half ago, I said by the end of this decade, the S&P 500 index will be 8,000. I hold to the number. And at the time I said it, some people in the audience, you may recall, kind of looked at me and said, "What you drinking?" Well, we're over 6. We could have a powerful infusion of growth, and not just in the Magnificent 7. How about the Magnificent 493 that are looking a little better now? So I'm optimistic because I believe the neutral real interest rate is going to remain low. I hope we don't get a bird flu outbreak that starts a second round of disease. That would be terrible.
Well, listen, David, thank you so much for your insights. Viewers, if you're watching this or listening, be sure to check out David's new book. It's called The Fed and the Flu, available on Amazon, Barnes & Noble, and any place you can buy your books. And don't forget to like this video and subscribe to the Money Show channel so you get updates that when new videos like this are posted. David, again, I thank you so much for taking some time out to chat.
Thank you, Mike. Nice to be with you.
Take care.